My dear students, welcome back to our channel. In this video, I will be explaining the MBA 4th semester subject Financial Risk Management as prescribed by Osmania University and other universities of Telangana. We will go through the important questions and answers one by one. Let's begin with a quick revision. Tips to remember. Short questions focus on definitions and key terms, right to the point with 2 to 3 lines and examples if possible. Long questions need explanation plus examples plus a small conclusion or real-world link, especially related to banks. ALM and VAR are core topics, don't skip these under any circumstance. Focus also on non-insurance methods, a classic theory-based question in every set. Unit 2 first important short question is: define VAR and CAR. Answer. VAR, value at risk, is a way to measure how much money you might lose on an investment in a certain time period with a specific confidence level. It answers the question, what's the worst case loss I can face? Example, a bank says its portfolio has a VAR of 10 lakhs rupees at 95% confidence over 10 days. This means there's a 95% chance it won't lose more than 10 lakhs rupees in 10 days. CAR, cash flow at risk, shows how much future cash inflow, like revenue, can go down because of risks like price changes, demand drops, etc. Example, a company expects 50 lakhs rupees monthly, but CAR says 5 lakhs rupees could be lost due to market changes. Quick tip to remember. VAR is equal to investment loss risk. CAR is equal to cash flow drop risk. Both tools help businesses make smarter and safer financial decisions. Next important short question is: 2. Stress testing and back testing. Answer. Stress testing is used to check how a business or investment will perform during extreme or unexpected situations like a financial crisis, war, or COVID-19. It helps in preparing for worst-case scenarios. Example, a bank checks how much it would lose if interest rates suddenly rise by 3%. This is a stress test to see if the bank can handle the shock. Back testing means testing a risk model using past data to check if it gives correct predictions. It helps in verifying if the risk model is reliable. Example, a company uses its VAR model on last year's data to see if predicted losses matched actual losses. If yes, the model is working well. Quick tip to remember. Stress test is equal to future shock. Back test is equal to past check. Together, they help in making sure risk models are strong and trustworthy. Next important short question is: 3. Asset liability management, ALM. Answer. Asset liability management, ALM, is the process of managing a company's or bank's assets, like loans, investments, and liabilities, like deposits, borrowings, to reduce financial risks and maintain balance. It helps in handling interest rate risk, liquidity risk, and credit risk by matching the timing and amount of cash inflows from assets and outflows for liabilities. Example: if a bank gives a 5-year loan asset, but its customer deposits are for only 1 year liability, the bank may face a problem when deposits are withdrawn. ALM helps manage this mismatch. Why it's important? Keeps the bank safe from losses. Ensures enough cash is available. Helps follow RBI rules and maintain financial stability. Easy tip to remember. ALM is equal to matching assets and liabilities is equal to less risk, more control. Next important short question is: 4. What is capital adequacy? Answer. Capital adequacy means how much capital, money, a bank has to protect itself from losses and risks. It shows the bank's ability to handle shocks and still run smoothly. It is measured using the capital adequacy ratio, CAR, which compares the bank's capital to its risk-weighted assets. Formula: CAR is equal to bank's capital divided by risk-weighted assets times 100. Example: if a bank has 100 crore rupees in risky loans and 10 crore rupees capital, its CAR is 10%. If RBI says minimum CAR should be 9%, then the bank is safe. Why it's important? Protects depositors' money. Builds trust in the banking system. Helps banks survive financial crisis. Easy tip to remember. Capital adequacy is equal to safety cushion for banks. More capital is equal to more safety. RBI and Basel norms set the rules for minimum CAR. Next important short question is: 5. Credit risk. Answer: credit risk is the chance that a borrower will not repay the loan or delay payments. This risk mainly affects banks, NBFCs, and lending institutions. It happens when people or companies fail to pay back loans, EMIs, or interest on time. This leads to losses for the lender. Example: if a bank gives 10 lakh rupees to a businessman and he is unable to repay due to business loss, the bank suffers a credit risk. Why it's important? Increases bad loans, NPAs. Reduces bank profits. Affects trust and stability in the financial system. Banks manage credit risk by checking credit scores, asking for collateral, monitoring repayments. Easy tip to remember. Credit risk is equal to borrower may not pay. More credit risk is equal to more chances of bank losses. Managing credit risk keeps banks strong and stable. Next unit 2. Long questions. First important long question is: discuss the non-insurance methods of risk management. Answer: in financial risk management, not all risks are covered by insurance. Many businesses use non-insurance methods to manage risks. These methods help reduce or avoid losses without depending on insurance companies. Here are the major non-insurance methods. 1. Risk avoidance. This means not taking part in activities that are too risky. Example: a company avoids investing in a country with political instability to reduce the chance of business loss. Easy tip: no action is equal to no risk. 2. Loss control. This means taking steps to reduce the chance of loss or reduce the size of the loss if it happens. Example: installing fire alarms and CCTV in factories reduces the chances of fire and theft. Easy tip: control before it's out of control. 3. Risk retention. In this method, the business accepts the risk and prepares to bear the loss using its own funds. Example: a company may keep 5 lakhs rupees aside as a reserve for any unexpected machine repair. Easy tip: self-cover, self-repair. 4. Risk transfer, non-insurance. Risk is shifted to another party but not through insurance. Example: in outsourcing, a company gives IT work to another firm, transferring the operational risk. Easy tip: let others handle the trouble. Benefits of non-insurance methods. Cost saving, no premium payments. More control over risk. Useful when insurance is not available or too expensive. Conclusion: non-insurance methods are very useful for day-to-day business risk management. By using avoidance, control, retention, and transfer, companies can reduce losses, stay stable, and make smarter decisions. Next important long question is: To explain evolution and concept of asset liability management, ALM. Answer. Asset liability management, ALM, is a method used by banks and financial institutions to manage risks that arise from mismatches between assets and liabilities. Concept of ALM. Assets, what the bank owns, loans, investments. Liabilities, what the bank owes, customer deposits, borrowings. If a bank gives a 10-year loan but the deposit is only for 1 year, this creates a mismatch. ALM helps to match the timing, interest rates, and amounts of assets and liabilities so that the bank can avoid risks like liquidity problems or interest rate changes. Evolution of ALM. 1. Early stage. Banks mainly focused on profit and growth, not on managing risks actively. 2. After 1980s. Financial crisis and interest rate changes forced banks to think about risk management. ALM started in developed countries and slowly spread to India. 3. In India. ALM became important after liberalization, 1991. RBI, Reserve Bank of India, made it mandatory for banks to adopt ALM practices to improve financial stability. Key objectives of ALM. Manage liquidity risk, having enough cash to pay when needed. Manage interest rate risk, profit can drop if rates suddenly change. Maintain capital adequacy and regulatory norms. Ensure long-term financial health. Example. A bank lends 50 lakh rupees for 5 years but takes deposits for only 1 year. If depositors withdraw after 1 year, the bank won't have cash. ALM helps to plan in advance to avoid this situation. Easy tip to remember. ALM is equal to balancing act. Assets is equal to income, liabilities is equal to expense. ALM is equal to smooth banking with less risk. Next important long question is 3. What is VAR? Explain how VAR helps in investment decisions. How is VAR different from CAR? Answer. Value at risk, VAR, is a financial tool used to measure the maximum possible loss on an investment over a specific time period with a certain level of confidence. Meaning of VAR. VAR tells us, how much can I lose, and with what probability? Example, if a bank has a one-day VAR of 5 crores rupees at 95% confidence, it means there's a 95% chance the bank will not lose more than 5 crores rupees in one day. It does not predict exact losses, but it gives a safe estimate to prepare for risks. How VAR helps in investment decisions. 1. Risk comparison. Investors can compare the risk levels of different portfolios or assets. 2. Risk limit setting. Banks and companies can fix limits on how much risk to take. 3. Capital planning. Helps in setting aside enough capital for possible losses. 4. Regulatory use. Used by regulators like RBI and Basel Committee to check financial stability. Difference between VAR and CAR. Point VAR, value at risk, CAR, cash flow at risk. What it measures: possible loss in value, possible drop in cash inflow. Focus area: investments, market value, business cash flow, sales, revenue. Usage: financial portfolios, banks, business planning, budgeting. Example: 5 lakh rupees, VAR means possible loss, 3 lakh rupees, CAR means cash flow may drop. Easy tip to remember. VAR is equal to how much investment can lose. CAR is equal to how much income can fall. Both tools are important to make smart, safe, and informed financial decisions. Next important long question is 4. Describe the RBI guidelines in the process of ALM practices. Answer. Asset liability management, ALM, is very important for banks to manage risks like liquidity risk, interest rate risk, and credit risk. The Reserve Bank of India, RBI, has given clear guidelines to help banks follow safe ALM practices. RBI guidelines on ALM, key points. 1. Three-level risk management structure. Board of Directors, final responsibility for ALM policy. Asset Liability Committee, ALCO senior management team that takes decisions. Operational staff handles data and daily monitoring. 2. Time buckets for liquidity management. RBI advises banks to divide their cash flows into time buckets, like 1 day, 2 to 7 days, 8 to 14 days, etc. This helps track when money is coming in, assets, and going out, liabilities. 3. Gap analysis. Banks must do gap analysis to find the mismatch between maturing assets and liabilities in each time bucket. Example: if more money is going out in the 1 to 7 day bucket than coming in, it shows liquidity risk. 4. Interest rate risk monitoring. Banks should calculate the impact of changes in interest rates on their assets and liabilities. This is called duration gap analysis. 5. Submission of ALM reports to RBI. Banks must regularly submit reports on liquidity position, interest rate risk, and ALM performance to the RBI. Why it's important? Ensures financial health of the bank. Helps handle market shocks. Builds public trust and follows Basel norms. Easy tip to remember. RBI ALM guidelines is equal to 3-tier structure plus time buckets plus gap analysis plus reports. These rules help banks stay safe, balanced, and well prepared. Next important long question is: 5. Explain the concept of risk avoidance, risk retention, and risk transfer. Answer: in financial risk management, different strategies are used to deal with risks. 3 common methods are risk avoidance, risk retention, and risk transfer. These help businesses decide how to handle uncertain situations and minimize losses. 1. Risk avoidance. Risk avoidance means not doing any activity that has risk. It completely removes the chance of loss. Example: a company avoids entering the firework business because it involves high risk of accidents. By not entering the market, it avoids risk altogether. Easy tip: no activity is equal to no risk. 2. Risk retention. Risk retention means the company accepts the risk and prepares to bear the loss, usually from its own funds. It is used when the risk is low or manageable. Example: a small shop owner doesn't take insurance for minor damages and keeps money aside to handle any small loss. Easy tip: face the risk, be ready. 3. Risk transfer. Risk transfer means shifting the risk to another party. This doesn't remove the risk, but the loss will be handled by someone else. Example: buying an insurance policy transfers the risk of accident or theft to the insurance company. In business, outsourcing IT services is another example, where operational risks are shifted to the service provider. Easy tip: your risk, their headache. Summary table. Method: what it means. Example: risk avoidance: don't take the risk at all, avoiding risky investments. Risk retention: accept and manage the risk, keeping a reserve fund. Risk transfer: shift the risk to someone else, insurance or outsourcing. Conclusion: all 3 methods help in different situations. Smart businesses choose the best one based on cost, impact, and control.